Welcome to the Money Over 50 podcast, brought to you by Dallas Davison and Michael Hogue from Money Over 50 Financial Advisors. This information is general in nature and does not take into account your objectives, financial situation, or needs. Therefore, you should consider whether the information is appropriate for you and your personal circumstances. If you require personal advice, please contact Money Over 50 Financial Advisors. Here are your hosts, Dallas Davison and Michael Hogue.
Welcome to Money Over 50 with Dallas and Michael. Dallas, a listener question today. So
thanks, Michael. I guess so this is a listener question or email we received from Darren, who I've had a meeting with in the past. So g'day, Darren. Hope you're well. Darren sent through an email with a link to a video of Warren Buffett. So as we've talked about before, Warren Buffett, great investor. Historically one of the best to ever do it. Warren Buffett has sort of made his name as a stock picker, you would say, picking individual companies that are going to outperform. So Darren sent through an email say, "Hi guys, attach a video link of Warren Buffett saying it's better to just own 3 good companies. Would love to know your thoughts on his comments." So I got a couple of thoughts. So the main overarching one for me here is that if I was Warren Buffett, or if I could have the chance to invest in Warren Buffett 50 years ago, and I knew that it was Warren Buffett, then absolutely, I would just invest with him, or I would just pick the 3 companies that he told me to be invested into. The reality of it is, though, for me, or the way that I think of it is, there is no way to know that in advance. There has been, since Warren Buffett actually started to invest, there are many people who would have told you, or someone else would have told you, that they were the next Warren Buffett, and that they were going to be able to pick and choose which companies you could own that would not just return the average of all of the best companies, but actually return better than average. So that's, I guess, my first thought is, the problem is it's all hindsight. And there's no way to know in advance that you can be invested with Warren Buffett, or that you can be invested in the 3 companies that he's talking about that perform really well over the next 30, 40 years. So you have anything to add to that?
Yeah, look, a couple of things. So I mean, looking back anecdotally on companies' performances and investment returns and things like that is a little bit useless from the point of view. It's sort of similar to if you could have the tomorrow's horse racing results today. You'd walk into the track and you'd back
gambling.
8
wouldn't
winners.
Be gambling, it'd just be winning.
We don't have that, and we can't have that. I like your point there. You said we're by its very nature we're looking at past returns. The other thing is that it also implies, and I think this is true for any narrow investment. So anytime someone wants to narrow down and say, I can just invest in 3 companies, I can invest in 1 company, I can invest in this. Look, it somehow implies that doing that would solve all of your financial problems. It doesn't. It's not a financial plan.
It's an investment plan.
It's an investment plan. It's not a financial plan. I can invest something. I can invest into. If I get 1,000% return over 10 years, will that achieve my goals and objectives? Well, the answer is it depends.
Did I put $10 in?
Did I put $10 in? Did I put 1,000 in? Did I put
like
what did I put in there? It depends on that. It depends on the tax plan that I have. If I lose half of it in tax, then obviously that dilutes my return right down quite a lot. Did I put enough into it? Did I take excessive risks? All of those types of things. So it does imply
that the investment
itself will solve all of your financial issues. It doesn't.
No,
it's very unlikely to. So
it is an interesting one, because I find this with so we know, and we've talked a bit before about, if you imagine a pyramid basically, and the base of that pyramid is investor behavior. So how much you spend versus how much you save. Do you stick to the plan? Do you stay the course? Do you panic when things are bad? Do you get greedy when things are good? You know, do you know where you need to be in order to achieve your goals? Are you actually crafting some sort of plan to get there? That's sort of the base of the pyramid, which is like any pyramid. That's really the key. That's what everything rests on. So what you're touching on there, I think if you think of it as the second part or the middle part of the pyramid, might be asset allocation. So do I own companies, or do I own cash, or do I own properties? Once I've worked out how much money I need to be saving versus spending, and how to most effectively put that aside for the future, which asset class do I choose to invest that in? That's a really important part of the pyramid as well. The very top of the pyramid, which is sort of what we're talking about here, which is, do I invest that money into the top 1,500 companies around the world, or do I just pick the 3 that I think are most likely to do best over the next 30 years? Not only is it, I think, impossible to do in advance or without the benefit of hindsight, but as you just touched on, it's actually not the most important part. So yes, if you can get the base right and you're doing everything absolutely right, and you've got your money invested in the right asset class that gives you the best chance to get there, and then you can also outperform, then that's gravy. That's fantastic. But what you've just touched on there is, if someone comes to me, if Warren Buffett, and I've read a lot about Warren Buffett, so I know a lot about how this works, is that if you look at Warren Buffett and go, why is he worth so much money? It's tempting to think that it's because he picked good stocks when he was 20, or as they say in America, or picked good companies. The reality is that what Warren Buffett has done since he was about 12 years old is that he has been relentlessly focused on accumulating wealth, to the detriment of a lot of other things in his life. But it wasn't necessarily just about which companies do I think are going to perform. When he was 12, he was doing paper runs, and then he started all these little small businesses when he was a kid. Then in his 20s, he basically dedicated his whole life to working in investment management, all these sorts of things. And what you found with him is it still was that by the time he was 50 odd, he was still only relatively wealthy. What really has made him one of the richest people in the world is the fact that he's compounded that for 70 plus years. So he's, I think, mid-80s now. He's been relentlessly focused on this for 70 years. And so his performance, that's probably another interesting one, is if you look at his actual investment performance, it's good. It's better than the average. It's better than the benchmarks. But it's not like he's returning 50% a year for the last 70 years, and the broader market's doing 10. And I'm making these numbers up here, but the broader market might have done 12, and he might have done 18%.
Yeah, it's something like that. Yeah, he's. I think it's something in that ballpark. It's instead of 12, he's averaged 18.
Which again, if you do that with a big enough, this is not to knock his achievement. It's more just to
no, it's definitely not to knock it. So yeah, that's a good time to raise this. I was also going to say, and he's Warren Buffett. Yeah. So he's renowned as probably the greatest investor to ever live.
Yeah.
It's absurd to think that anyone else could actually
rely on that.
Rely on reading what he says, and then trying to apply that for their own situation. Now, if someone limited you to only three companies, you could probably most of the time achieve most of the things with a good financial plan overlaid. So the funding plan, like we said before, how much do you put into those companies on a regular basis? The tax plan, what structures do you own that? You don't want to lose excessive amounts of tax. Stick to the strategy. If you had a monkey throw three darts at the ASX 200 and hit three companies, and then another monkey come along and threw, and that's your portfolio. You can only invest in those three forever. Here come the next couple. Another monkey comes and throws three darts. And you did that with 100 monkeys. You'd end up with a mixed bag of three different companies for each couple. Now, on average, they'd probably all do fairly well. Like they've got the asset class right.
Well,
productive enterprise. They've got the funding plan right. They've got the financial plan right. They've got the tax plan right. If you can get all those things right, on average, if you're throwing a dart at publicly listed companies,
Yeah.
you're probably on average going to do okay.
By their
You're
very,
probably gonna do
by
okay.
their very nature,
Yeah.
the fact they're publicly listed means there's no huge, they have some sort of business model. They have some sort of corporate governance. So, yeah, it is, I think even if two couples came to me and you said, right, they both got $700,000 in superannuation, and we've calculated that over the next 10 years they need to get to $2 million.
Yeah.
If you said to me, I've got this couple here, the limitations are they will do everything that you tell them in terms of making contributions to super. They will stick to the plan. They won't panic and sell. They won't get too greedy. They won't, they'll just stick to exactly what you tell them to do. However, your limitation is you can own, even me, who I'd go out of my way to not try and pick companies. I said, you've got this perfect client, and all they do is exactly what you tell them, but you can only pick 3 companies to invest into. I think I'd probably underperform the average of that benchmark, but I still think I'd get them pretty close to there because they would be doing everything else right. Yeah,
because what we're talking about here is that if there were 50 years ago, if there were 2 families in Australia or America, let's say America, and one of them was fortunate enough for Warren Buffett to walk through the front door, knock on the door and say, give me all your money, I'll invest it over the next 50 years. And they did that. And their neighbours, Warren Buffett never knocked on their door, and they just invested in the largest 500 American companies. They both did excellent.
Yes.
Over that period of time. They both achieved all their goals and objectives. Now, the family that Warren Buffett walked in through the front door, if you looked at their net worth, it's considerably higher than the other family. However, they both achieved
everything they needed
what they wanted to do. So, because not to say that it won't work. If we're looking at this, it's certainly not to say that it won't work. I mean, there's plenty of people around Australia and the rest of the world that have all of their net worth tied up in one company, and it's called their small business. And most of those people do okay. Now, so if you're extending that and saying, well, I'm going to diversify by investing into 3 much larger publicly listed companies, you're probably going to do just fine. Is there? That's not our model.
No.
Our model is we believe you can be more diversified than that, and do it for a really low cost, a low fee of being diversified, and not have to have that added worry.
Low stress. Like I laugh because I'm thinking about this as a I just imagine Darren or me or anyone who's married. Could you imagine getting this wrong? Imagine if you're the one. So you're married, you go, right, we're 10 years out, we've got this money, we're going to invest this for retirement. Could you imagine getting it wrong? Like it's not worth. It doesn't bear thinking of. Like if you get it right and you outperform, that's it's a bit like giving, as you said before, the horse racing tips. It's a bit like giving your mate tips about what you think's going to win the race. If it wins, they sort of shrug. If it loses, you're the biggest idiot in the world. Like people don't respond well.
And look, the issue when you're making that 3 company decision, look, you can't help but be influenced by what's happening around you. And what I mean by that, we did a podcast not so long ago where we actually, I forget the name of it, where we compared we looked at the drop that's happened in the first half of 2022, which is about a 16% drop. But then we looked at the drop that Netflix had suffered. We looked at the drop that some other sort of high profile companies like Zoom and things like that had suffered. Which was considerably more than the 16% that the rest of the market had suffered. Usually when you're making the decision to invest into 1 or 2 or 3 or 4 companies, you're going into the most popular companies at the time. And they're the ones that are actually susceptible to the biggest drops. Because what's usually happened, why they're in the news, why they're popular, is because the price has been pushed up to artificially high levels. So when it does fall, it falls harder.
And that's I guess a good point.
That's human nature.
And Warren Buffett doesn't do that because he spends 10 hours a day sitting in a room reading and trying to unearth the next company. And there's a lot more to it and how they approach investing and all the rest of it. But from the early days, by its nature, him and his partner were spending 10 hours a day sitting there just trying to find the unearthed thing that no one else knew about and no one else was talking about. They were not going out there and buying 3 big publicly listed companies. That's not what they were actually doing.
No.
And I actually I didn't try and find the YouTube clip to censor it, Darren, because I thought it doesn't sort of matter too much. But I also know that I've seen a clip talking about this with Warren Buffett, where someone asks him at a shareholder meeting about, if you had a million, and it was a really sort of long-winded question they asked about, if you didn't have any dependents, you didn't have any, if you've come into $1 million in cash and you've got no real need on that for the long-term future, and how would you invest it? And he basically says something like, I'd put it in an index fund and I'd go back to work. So, and he, without meaning to, he's kind of making that point of like, what that person does over the next 30 years of their life is far more important than the returns they get on that money.
Yeah, look, absolutely. So he's dedicated his life to that. Yeah. It's a really good point. When I'm retired and I'm living off the money that my money makes by going to work, by my money going to work, not me. Look, I just don't want to be worried about. No. I don't want to be worried about what the decisions that 3 CEOs make.
Yes.
I know that if I spread my money over, over 1,000 CEOs, chief executive officers running all, over 1,000 companies, I know that I don't have to worry then. That's I've diversified enough where I can actually just relax while I'm traveling the world. Yeah. Whereas if I choose that, if I narrow that down, I can't really retire and go traveling. Yeah. I've got to be on all the time. Yeah. So
that's a good point, because you raised that about the small business owner thing. There's nothing inherently wrong with concentration or under-diversification. That's by its nature. A lot of our net worth is tied up in our business, and that's what. But the difference there is we're spending 8 hours a day focused on purely something that I believe that we can control to some degree. Yeah, in any business, a lot of factors are outside of your control. But to me, owning 3 companies is sort of the middle ground where I don't actually have any control over how those. It's not enough companies to give me peace of mind that I'm spread out and diversified, and that if one of these CEOs goes off the rail and starts making crazy decisions, like you said, I still have to be on. I still have to think about it. I still have to worry about it. But I'm actually not in any control of those things. So to me, it's sort of if you're going to focus on something that you can control, and if you can't control it, then you want to be as diversified as possible so that you've got peace of mind that the lack of control isn't going to hurt you.
Thank you for listening to the Money Over 50 podcast with Money Over 50 Financial Advisors. For more information and resources, visit the Money Over 50 website, mo50.com.au. We look forward to catching up again soon.